Welcome to Stockwatch with me, Ntauleng Lechela. And joining me to unpack your stock-related questions today are Grant Nader from Benguela Global Fund Managers and Jared Houston from All Weather Capital. Be sure to send your questions through via email to stockwatch@bdtv.co.za, via SMS on 41392 or on X @BusinessDayTV using the hashtag Stockwatch. Jen, thanks so much for your time this evening. Jared, let's start with you. Gold continues to surprise us, topping, record after record every week. Just last week, Goldman Sachs had upped its target to $5,400, and we passed that. It's getting more and more difficult to call the top.
I think absolutely it has been a tremendous run for the gold price, and the gold shares have followed suit. I mean, if you just look at the moves month to date, we're seeing north of 30% in some of these counters in a single month so far. So it has been a significant move on the back of a very strong price appreciation last year. So you can understand some of the cautiousness that's starting to set in terms of how frothy this might become. If you just look at post-out close, there is a bit of a pullback in the gold price. So It is one just to watch in terms of potential drawdowns and volatility in around these levels. I think we've discussed previously the nature of the move. I mean, there are some kind of key fundamental drivers driving the gold price, being the kind of global uncertainty and the monetary and fiscal policy at the moment, just driving this demand for kind of safe haven type assets. So we can understand that, but the rate of change has been quite dramatic in a short space of time. It will be volatile and subject to pullbacks like we are seeing a bit this evening.
Yeah, and we had the graph up at 5,300 an ounce, down 2%. Grant, I think this is our third week together, and every time we chat, the yellow metal has hit a fresh high. Talking expectations, right? A JP Morgan analyst is now pricing in gold at $8,500. Looking at its tail, it doesn't seem impossible at this point.
No, it doesn't seem impossible. And if you look at the largest bull markets in the 70s and I think it was the 80s or 90s, the rallies were a lot further and were higher as well. So there potentially is still room. And I think the structural drivers that Jared was alluding to, I mean, the world's monetary regime is changing.
Yeah.
The way the world's geopolitics fit together is changing. There is no telling with certainty where that ends. The only thing we know with certainty is charts don't go up in a straight line indefinitely. So personally, I would like to see a little bit of a healthy correction along the way. If we are going to end up getting to 8,000 and we go there at the rate of change we've been going now, that's going to lead to all sorts of drama when things unravel, and that's not a healthy market. What you want is a healthy rise in a commodity price. So we've had a massive run. Let's have a pullback. Let's have a 10, 15, even 20% won't even take us back to where we were in June last year. Settle down, clear out some of the speculation, because I think a lot of speculation is starting to be drawn to, you go look at the financial commentaries on Twitter or X and Reddit, it's all gold and silver, gold and silver.
Yeah.
That's a worrying sign from a speculation point of view, and we know as investors that's usually difficult to make an investment case on speculative foundations. So I'd like to see a little bit more of a healthy price action, while I am still bullish on the bigger picture for gold.
And I mean, as you mentioned there, what goes up must come down. So bullish when it comes to gold. Are you as bullish when it comes to PGMs, also caught up in that precious metals rally? Grant, I also noticed that BlackRock upped its stake in Sibanye-Stillwater.
Yeah, there's the sudden awareness of the need for strategic metals and security of commodity access, whether it's precious metals, whether it's rare earths, whether it's copper, and because you can't rely on your supply chains. You don't know if your traditional supply chain, most of that is actually China now, and your allegiances are breaking down, and are those dependable? And given the nature of the importance of AI and defense and some of these critical industries, you can't risk not having constant and secure supply to a whole swath of critical metals. And I think there's this rush to stockpile. That's part of this this access that we're seeing, the shortage of metals and the prices being squeezed. And I think that's just another layer on top of this global instability, and it's a sort of an outcome of that as well. In addition to which, there is fundamental demand. But I've seen commodity rallies before. I was around in the 2000s, giving away my age, and it lasted a long time, and it went a lot higher than you thought it would go. So I'm not calling this too early or too much. Bigger picture. That doesn't mean it can't go down 10% tomorrow.
Yeah. And is this what's playing out in silver as well, Jared? You know, there's been talk about silver's appeal when looking at key technologies like your AI, EVs, as well as solar technology.
I think silver's rise of late has been kind of even more spectacular than gold and BGM. I mean, certainly there's a catch-up element to the price move, and I think there is quite a lot of speculation just given the nature of how quickly it's gone up as well. I hear you on some of the components that it is used in. I mean, looking at some of the graphs, I mean, silver made up a very small component of kind of solar installations, but the rise in price is such that all of a sudden it's a very meaningful component of the cost of these products. So you can see how dramatic the rise is. It's distorted the cost of goods of some of these industries, and we're likely to see a lot of kind of unintended consequences substituting in the like of these types of moves, just given how significant they have been.
Yeah, let's move over you can continue.
Sorry, I was going to say, you mentioned Sibanye-Stillwater earlier and BlackRock upping their stake. I thought it was interesting just to note that they hosted a strategy day today, the new CEO presenting on some of the kind of key targets, just outlined what we thought was a very reasonable update from them, talking about a simplification of the portfolio and really focusing on the PGM assets, trying to drive down costs in their gold production as well. So new CEO saying the right things, outlining clear targets and a very well articulated strategy.
All right, I want us to move over to something that's less speculative, right? Let's look at those tech earnings that have come through, starting with Microsoft. It posted a beat on earnings, a beat on revenue, but slight moderation when it comes to that cloud business. Is that what is disappointing investors, Jared?
Yeah, sure. So I mean, when I looked at it earlier, I mean, Microsoft was down 11%. So certainly a significant reaction to the earnings. I think the actual earnings itself look just about in line, but like you mentioned, there are some concerns with regards to the quantum of capex related to AI, the timing of actual revenue benefits and costs coming through in the business, and then obviously competition from some of the other providers as well. So you can see it is a bit of a contentious issue. Some of these shares have performed extremely well on the back of this AI premium, and where we see kind of some type of doubts in terms of this thesis coming through, you are likely to see pullbacks.
Your take on Microsoft, Grant? It also seems like we are still in that era where we're going to see big AI spending build. We can also look at Meta's results, which market cheered.
Yeah, which is quite interesting. They both upped their capex guidance. Meta went up 7% or whatever it is, and Microsoft down 11-12. You know, I think we get caught a little bit in the noise. If you just zoom out, it's actually a very strong set of numbers. This company, you know, growing revenue in the high teens on the top line. They've got a massive cash flow generation, but the problem is they're spending it all on the capex. And then the question mark comes, the depreciation is going to start catching up to them if they don't start increasing the monetization. But I think these things are highly cash generative. They could pull back on the costs and the capex if they needed to at any time. So, you know, I'm not too worried about the outlook for Microsoft. I think it's a phenomenal business. I think a very strong set of numbers. People are getting caught up in the minutiae of did it beat or miss.
Yeah.
You know, bigger picture, it's still very well positioned to capitalize on this build out. And it's going to be one of the hardest stocks to disintermediate or disrupt as AI unfolds. So I still think it's a good business in a good position, and you should probably see it as a buying opportunity in the pullback.
And where are we when it comes to those, you know, the talks around overstretched valuations around AI bubble concerns? We've seen some of the numbers coming out, even from players like ASML, TSMC. How do we make sense of it all as we get these numbers filtering through, as we see those big spending bills, those capex numbers coming through as well, Grant?
So I think for starters, Microsoft has devalued significantly from over, I think it was around 33 times earnings less than a year ago. It's now around 27 times, and with today's move, probably 26 times. It's getting cheaper. It's getting a bit more reasonable in the context of a company that still generates probably 40% of their earnings overseas. So in the weaker dollar is going to be helping them. I think the bubble risk, you can't ignore it. You can't say it's not real. However, I don't see a world in which we go backwards when it comes to AI. The real key is how do we monetize it, and this is the year where people need to show that ROI. They need to show that demonstrable return on these massive investments, especially because they're upping them even more. And I think as the year unfolds and you don't see that, that's when I think there's a risk. You've got another big investment in OpenAI from SoftBank of 30 billion potentially coming. And OpenAI feels like the weak link in the chain because they've got massive commitments to purchase all the way through this ecosystem. And yet, where they're getting the money from, they're slow to monetize this venture, unlike Anthropic and some of these other guys who are cash generative. So there are some weak links. Oracle is another one. I still think the capex build out, the hardware build out is going to continue for at least another 2 or 3 years. I mean, the AI, and something like this AI transition doesn't happen in 3 years and then it's over. This is an 8 to 10 year transformation. So I think we're still quite a long way to go. You just need to know that you're playing in the right spaces. And I think, as you mentioned, the hardware, the picks and shovels, the ASML, these are the better places to be.
Yeah. Do you share the same sentiments when it comes to that, Jared?
I think I've got some mixed views in terms of the AI space, and I think you'll see quite different results from the companies depending on the specific area that they're in. So you mentioned Facebook and the market reacting well to the earnings beat that came through. I mean, Facebook is getting quite an immediate benefit of AI in terms of its ad targeting business, obviously heavily reliant on advertising spend through the social media platforms, and the ability to monetize the AI spend through better ad targeting and click-through rates is quite a quick beneficiary that you see flow through to the income statement. Whereas some of the other companies' ventures are more longer term, as kind of Grant mentioned, where you're building kind of new subscription models and revenue sources that don't exist. It takes some time to flow through whilst there's the immediate kind of capex spend and then depreciation that follows thereafter. So I do think different companies will see the benefits slightly differently. There is clearly intense competition and lots of spend going on at the moment. So I think not all of these companies are going to emerge as winners within the specific space. And we have to kind of note that there will clearly be competition, not just from the American hyperscalers, but the Chinese players as well. So it is a space to watch quite closely, but a lot of money going into it that's going to need to generate a return to justify these valuations.
The luxury stocks. Numbers out from LVMH seemingly beating some quarterly forecasts, but that was not enough to impress investors. The company also warning that 2026 won't be an easy year. A sudden turn, Jared, because late last year it looked like the luxury market was recovering. It looked like the numbers were getting better. What's going on? Why the disconnect? Why the change?
Sure. So we see, I mean, we spoke in the first half of the show about the gold price. And I mean, certainly gold is one of the inputs into some of the luxury goods. I mean, more relevant for the likes of Richemont than LVMH, which got a broad portfolio, including soft luxury. But I think there is, I mean, sales have held up relatively well in some of the markets. I mean, clearly there's a wealth impact with markets going up and people feeling a little bit more confident about what they have to spend at the top end. But I think the concern going forward is what happens to margins.
Yeah.
I mean, clearly there's an input cost element that's going up quite significantly. Prices are going to have to be risen further in the future that may constrain demand. And then what happens to the actual margins that come through? Are they able to sustain this with the fast rising input costs? I think that's probably the question mark from this point.
And you talk about margin pressure, and that was going to be my next question. You touched on Richemont there. Let's get your views around that, Grant. A viewer noting that Richemont has lost about 15% since the latest results about 2 weeks ago. Is it on the back of, concerns of that higher gold price?
Yeah, I think that's absolutely the biggest unanswered question. So they gave us guidance about strong sales, and they continue to, in my view, they're actually standing ahead of the peers.
Yeah.
They've got the hard luxury, which is premium product, and the soft luxury, as Jared mentioned, the handbags and scarves and the like, that's struggling. That's slower to recover. So Richemont is operating at a really high level, but gold has gone up, it's doubled. And that's obviously, when you're talking about jewelry and watches, it's a big input cost. And so We're waiting to see what's the visibility around the margin and how much stockpiling do they have and what's the hedging. But if this is a structural change in gold price and it doesn't fall back in the next year or two, this could be a reset entirely in their margins. And Richemont's not going to go up their price by 20% in the next 6 months. They tend to incrementally increase it a few percent over time. So they don't chase away their customers. Johan Rupert, I mean, it's one good thing about him as a business owner. He'd rather sacrifice a bit of margin and recoup slowly over time. And so I think you'll see a significant compression with eventual recovery, depending on where gold goes. And that's really the unanswered question. It's still a great business, but what's the level of profitability that you're looking at this point?
Yeah. And Grant, will the stronger rand also have an impact on a company like Richemont?
No, very little of their sales come from SA, other than the fact that we're a rand. So we buy the Swiss franc. It's pegged to the Swiss franc line. So the stronger rand gives you a weaker, translation effect, but it doesn't impact their earnings in absolute terms.
All right, let's move over to Woolies, out with an update today, pegging earnings growth of up to 12% for the interim period. Interestingly, it did see growth across its divisions, which is, surprising, because we do know that some of the other divisions lag, and we see most of the growth coming out of food. Let's get your take on that update, Jared, because that share price was also under pressure. I think lost 6%.
Yeah, that's correct. Ended down 6.2% and kind of finished the day towards kind of the low point. I think, like you mentioned, at first look, the trading update wasn't too bad in terms of the bottom line guidance, but I think some concern in terms of sales and the slowdown incrementally towards the end of the period. So we just have to kind of watch what that means going forward. The other concern that I'd cite is on the GP margins. So if you think about it, we've seen a bit of a familiar theme come through from a few of the retailers that have given us updates so far. There's been quite a lot of discounting in the market to clear stock, particularly on the apparel side, and you're starting to see that flow through in terms of margin. We'll only get proper guidance once we actually see half results, but it does appear that there is some discounting there. That is going to hurt the GP margin of the business. But within it, we saw kind of better sales come through from the home and beauty departments, as you'd expect. Food holding up okay, and apparel and Australia under pressure. It's been a kind of similar theme from Woolies in the last few years. I don't think Woolies is particularly expensive at this level. You still have a case where you are paying just about the share price for the food business and a lot of optionality in the rest of the businesses which aren't priced, which is a question mark about what this result means for near-term earnings and perhaps margin pressure.
And looking at that sector as a whole, Jared, we also got numbers out of Mr. Price yesterday. That counter also not faring well after the numbers were released. Talk me through, I guess, the sentiment around the clothing retailers. I know that Mr. Price, of course, still has the NKD deal hanging over its head. But was the losses in its share price yesterday mainly on the back of that update?
I think NKD is the big elephant in the room and kind of where all the question marks sit. So they didn't give any update on NKD. So no kind of further guidance from there. I think, slightly different impacts in terms of base effects for Mr. Price versus Woolies. If you look at, Mr. Price had quite a tough base that they were cycling, whereas Woolies wasn't particularly tough. So perhaps the sales not being stronger was a bit of a disappointment in that respect. On the Mr. Price side, they are cycling a tough base, but again, concern about slowdown in sales and margin compression there. I think the concern for us kind of broadly about the apparel space, and clearly the consumers under pressure in terms of discretionary spend, and discretionary spend is increasingly diverted to other sources rather than just apparel and food spend. The online gaming space is well published in terms of the impact that that's had. I think the other factor just to be aware of is competition from online clothing suppliers, particularly women's fashion is a big part of the category, and we're seeing increasing competition at very competitive price points, disrupting that market quite significantly. So to stay relevant in the category, I think you have to be innovative, you have to be at the right price point, and it is difficult to churn out reasonable sales growth. But your ability to protect what is still very high gross margins in the space is increasingly a question mark for the sector going forward.
And we have seen some of these clothing retailers, really diversifying outside of, clothing just being its main source of income. And there's a question here on Pepco, Grant, and whether you prefer Pepco based on the scale of their business and its fintech division versus a smaller player like Weaver Fintech or Lesaka.
It's a good question. I think Pepco is doing an amazing job of driving this fintech growth. If you think about it, they've got, I don't want to misquote, I think it's like 6,000 stores. You've got people walking into that footprint every single day. You're now able to, if you get it right, you can sell that person one extra thing every time they walk in the door. So they're finding a way to complement that built-in infrastructure, that loyalty, that brand awareness that's already there. Everyone loves Pep. They know them. They shop there. And they're selling into that. They've opened the credit up a little bit, cell phones, other fintech offerings. So I think they're doing an excellent job, and I think the growth is testament, and I think there's still runway there. So for me, that would be my preferred play for sure.
Yeah, and I think Mr. Price also mentioned its telcos unit there doing really well over the third quarter. Jared, let's get your view around that. Those fintech players, we can even put in the likes of Optasia in that space that's recently listed and drum up so much attention.
I think all very different businesses, very different offerings, and some overlap certainly. But I think I agree with Grant. I mean, Pepco is relatively well placed within its core apparel business, but the exciting part of the business is clearly the fintech growth angle. I mean, there is talk about them launching a bank and what that might look like. Just given the store footprint, the loyal customer base that they've got, and the ability to lend and sell other value-added products into that space is quite significant. It's not going to be without competition from the likes of other players that are already in that space, but it is certainly one thing to watch. I think broadly, I mean, it's been an exciting back end of last year for the fintech space in South Africa, and you saw a number of deals take place. I mean, the Akorka deal that Nedbank did was particularly interesting. I thought the 10X deal Old Mutual announced also super interesting. You saw Optasia list at the back end of the year. All these deals commanding reasonable valuations, and I think it is an area of growth. I mean, the fintech adoption in South Africa has been relatively slow compared to global peers. I mean, if you just benchmark it in terms of the profit pools and the disruptions compared to the traditional players in the finance space, we have been slow to adapt. Hopefully this is a sign of things speeding up, and we'll see more of these types of deals come to market.
Yeah, you're absolutely right about that. You look at the likes of an MTN and Vodacom and their fintech offerings and how well they're doing in other African countries compared to South Africa. All right, it's time for us to get into your stock picks. Grant, what are you hanging your hat on today?
So I'm going with PSG Financial Services. I did pick it probably just over a year ago. It's really, it's a perfect environment for business like that. You've got obviously a high quality management. This has been one of the best compounders over the last 10 years. You've got a rising markets, so the actual fee base is growing. There's a bit of a wealth effect. People are going to come to them for advice. A lot of uncertainty, a lot of geopolitical risk. People want an advisor. They want someone to talk to. So I think this business is just going to continue going from strength to strength. They're an aggregator of independent financial advisors, rolling them up into their business, and they're driving growth through that. Plus some of the other, they're an asset manager and they sell insurance. So great business, one of the most sort of under the radar, high quality stocks in SA. And I think SA is the place to be this year. So that's my stock pick.
Are you sticking with SA, Jared?
It's a bit of a hybrid, my pick. So my pick is Investec Bank. So Investec there's essentially 5 distinct businesses within the group. There's a South African bank, there's a UK bank, an SA wealth manager, UK wealth manager, and then they've got a stake, 10% stake in the 91 asset management business. So a bit of a combination. We've got a positive view broadly towards the SA banking sector, just given lower interest rates are more conducive to lower credit losses and higher lending within the system. And I think broadly banks should trade well operationally. Investec has been a big laggard within the SA space, despite the banking sector trading well in South Africa. UK banks are up kind of north of 50% last year. Wealth management businesses in the UK have also done extremely well. Investec have got a stake in Rathbones, which is also up significantly. 91, I think, was up also 50% the second half of last year. So a lot of tailwinds to the parts of Investec, but the actual Investec shares lag quite significantly. We think, operationally, it's a very well-placed business, very high capital levels within the business, and a large buyback program, circa 2.5 billion that's ongoing in the market. I think operational momentum in terms of earnings will increase, and then just given the kind of capital position and the sum of the parts, there's always options to unlock value within the group. So we have good upside in the sum of the parts case on Investec.
All right, let's leave it there, gents. Thank you so much for your time and sharing your insights with us this evening. That's all for Stockwatch today. Thanks to our guests, Jared Houston from All Weather Capital and Grant Nader from Benguela Global Fund Managers. Up next, the close.